Welcome back. In these last few sessions, we've looked at four different strands of growth investing. In the first, we looked at investing in small cap stocks as a growth investing strategy, though we noted that you could be a value investor investing in small cap stocks as well. The second, we looked at investing in IPOs at the time of the offering as a strand of growth investing. The third, we looked at using screens to find growth at a reasonable price, either earnings growth screens or PEG ratio screens or price earnings relative to growth screens. And in the fourth approach, we looked at being an active growth investor, investing in young growth companies at the start of the process and hoping to make money as they succeed, if they succeed. As we looked at those approaches, some of you might have been tempted by one or more of those approaches, saying, I'm going to go down this path rather than the value investing path. And I'm not going to dissuade you from doing that. But remember, when you decide to become a growth investor, you are fighting history. Fighting history in what sense? We know that over a very long time period, stocks that are bought by value investors, low PE, low price to book stocks, tend to earn much higher returns. And as you can see in this graph, the lowest PE stocks earn much higher returns than the highest PE stocks. Now, this is not always the case, but if you're a growth investor, you're going to be at the low end of the spectrum in terms of returns because your companies will tend to have much higher PE ratios. So you might wonder, why would I do this? Why would I fight history? There are two reasons. One is there are periods where growth stocks outperform value stocks, where high PE stocks do better than low PE stocks. And this graph actually suggests one potential scenario where you might go with growth stocks over value stocks. The way to read this is anytime you see a blip in the blue line above the axis, that's a period where growth stocks outperform value stocks. It doesn't happen that often, but when it does happen, you could make money by investing in growth stocks. It looks at least like that is more likely to happen when growth is scarce. When earnings growth for the market is low and earnings growth is scarce, it looks like growth stocks outperform value stocks. Effectively, to use this approach, though, you have to be a market timer of some sort to be able to predict when earnings growth is going to be low. But that might be one opening that you use, that you're enough of a macro market timer to be able to find those periods where growth stocks will outperform value stocks. But there's another optimistic sign for growth investors. It turns out that when you compare active growth investors to growth index funds and active value investors to value index funds, that active growth investors seem to have a much better shot at beating growth index funds than active value investors have in beating value index funds. In fact, in a paper in 1995, Bert Malkiel noted that the average actively managed value fund outperformed the average actively managed growth fund. The average actively managed value fund underperformed its index by more than the growth fund I know it sounds confusing. So if you just compare growth funds to value funds might come out as winners. But if you look at active growth funds versus growth index funds, active value funds versus value index funds, it looks like activity in general seems to pay off more if you're a growth investor than if you're a value investor. That sounds like a contradictory finding, right? So how do I explain that contradiction, that low PE stocks beat high PE stocks, but activity in growth stocks seems to beat activity in value stocks? I think there are three ways to explain the contradiction. The first is if you look at the kinds of companies that growth investors look at, which tend to be high growth companies, often smaller companies, they tend to be smaller and less followed than the large market cap mature companies that value investors look at. As a consequence, your chances of finding mispricing is greater if you're a growth investor than if you're a value investor. The second is, if you look at the stocks that value investors focus on, mature companies with long established histories, they tend to be companies that are easier to value. Most investors can value mature companies. Growth companies, on the other hand, are difficult to value. And the younger the company, the more growth potential it has, the more difficulty there is in valuing the company. You're saying, so what? When valuation becomes difficult, most people give up. So if you're the kind of growth investor who has the persistence to hang in there and actually value companies, you might be further ahead of your competition than a value investor doing the same thing with value companies. And third, Many growth companies tend to be in newer sectors, sectors that people don't understand as much. So if you're a growth investor who can invest resources, learning more about that sector, social media, technology, whatever the sector is, you might be able to use that sector specific knowledge to find cheaper companies within that sector. Whereas if you're a value investor, the kinds of companies you might focus on might be companies in established sectors. A beverage company, for instance, there's not that much you're going to be able to bring into the game that's new and different. And if you're not able to bring in much, you're not going to be able to take away much. So active growth investing seems to beat active value investing if you define active as comparing that investing strategy to an index fund. Here are the pitfalls to watch out for, though, if you decide to go down this path and become a growth investor. Remember, scaling up is hard to do. So if you're a great growth investor and you start small, it might turn out that if you try to become bigger or you're forced to become bigger, that what worked for you when you were a $10 million or a $50 million investor might not work for you if you're a $500 million or $1 billion investor. In other words, if your focus is on young, promising growth companies, that might be okay if you run a small fund, if you have a small amount of money to invest, but it might be very difficult to do this if you get larger. So there's a price to success here. The more successful you get, the larger you get. The larger you get, the more difficult it becomes for you to keep finding the kinds of bargains you found in the growth sector, whereas value investors might have an easier time scaling up. Second is, remember that it's not growth per se that adds value, it's growth with excess returns. You have to bring in the other side of the equation. So when looking at companies with high growth, you always have to ask the question, how much is this company investing to get that growth? Because it's that trade-off that determines whether growth creates value or destroys value. And third, remember, growth companies tend, as I noted in the last slide, most people don't value growth companies. They invest based on what everybody else is doing, which means that the momentum game is going to be far stronger with growth companies than with value companies. So what? Well, the momentum game can take the price away from the value, and growth companies, this can happen for extended periods. So you might find the right growth companies. You might buy those right growth companies. You might not make money if you don't hold them for 3 years, 5 years, or 10 years. So let's flesh this out a little. Scaling up is hard to do, and here's a graph that brings us home. This graph actually looks at the revenue growth at IPOs. Now, the year that they go public, 1 year after, 2 years after, 3 years after. And you can see how quickly the revenue growth at IPOs drops off. So in the year after they go public, the revenue growth at companies that have gone public is 15% higher than the growth rate of the sector. By the time you get to 5 years out, the growth rates of these companies match up to the growth rate of the sector. So if you're a growth investor and you buy high growth companies, you've got to be very, not only do you have to worry about your portfolio scaling up, you have to worry about companies scaling up, because as they get bigger, it becomes more difficult for them to maintain growth. Second, remember that growth to have value has to generate excess returns, which means you got to do your homework. If you're investing in growth companies, not only do you have to look at the expected growth, you have to look at what the company invested to get that growth and what kind of returns it's making on that investment. That'll require you to face up front what investment actually means for a company, saying that's easy to do, let's just go into the balance sheet. Well, for some companies, accountants don't capture what a company is investing very well on a balance sheet. And in particular, I'm talking about technology companies, service companies, where capital expenditures often don't show up as capital expenditures. They show up in the income statement. R&D expenses, classic example. So if you're going to invest in growth companies, you got to invest the resources in thinking about what growth actually means at these companies, what capital expenditure, what investment actually means at these companies, and what you're getting in return for that investment. And finally, the momentum game is a serious problem if you're a growth investor investing based on the value of growth. So let's assume you're on the left-hand side of the equation. You've done the right thing in assessing growth and the value of growth and the investment in growth. You've come up with the estimated value. On the other side of the equation, you have demand and supply setting prices. With growth companies, the price might have little to do with intrinsic value because demand and supply can run away from intrinsic value. Investors can get caught up in the momentum game, push the price away from the value. Another way of saying this is you can find a cheap growth company, buy the cheap growth company, and find that the gap between price and value that attracted you to the company becomes larger over time rather than smaller over time. So if you're going to be a growth investor, I would suggest that you think about what drives the gap. Think about catalysts that might make the gap smaller. Bring in some behavioral finance into the analysis. Think about what might cause investor psychology to change and the momentum game to shift, because all of those factors will play in determining whether you actually make money as a growth investor. So in summary, the overall evidence seems to suggest that growth investing doesn't work. Value stocks beat growth stocks, but if you dig a little deeper, there are periods where growth stocks win, and activity in growth investing seems to pay off more than activity in value investing. So the reasons for that might be the kinds of companies that you look at as a growth investor. There is a bigger payoff to putting in the research, putting in the work, valuing the companies. What are the costs? You got to remember that scaling up is hard to do, both for the companies you're investing in, for you as an investor. Second, remember growth is not free. That investing for that growth will determine how much the value of that growth is. So look at what's put in versus as well as what comes out. And finally, remember the momentum game can work against you. But if you're able to play the growth game well, there's no reason why you cannot be a successful growth investor. Thank you very much for listening.